Good morning and welcome to this Wednesday, April 28th, 2021 edition of Trading Places Live at Earnings Beats. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we got earnings season certainly kicking in, no doubt about it. A lot of companies reporting last night, a lot more reporting this morning, some crazy swings in terms of price action. And, one of the things I do when I'm going through earnings season is obviously there's a lot of risk holding any stock into earnings, regardless of whether they beat or miss. Sometimes you see your companies miss and they go up. Sometimes they beat and they go down. It's really about looking at the big picture chart, understanding whether they did beat or miss, because I think that has a longer term impact on the stock. And then just kind of looking at that big picture and getting a sense of, okay, is this stock just consolidating a previous advance? Because a lot of times you'll see stocks report good numbers and they gap down and you don't quite get it. I know sometimes when I'm holding a stock into earnings, which I try not to do very often, certainly not big positions, it gets very frustrating to see some of the stocks that, look like they were pretty good reports, have been in nice uptrends, but they gap down. And many times it's just part of a bigger picture consolidation basing period that a stock has to go through before it makes another breakout and starts trending higher again. But looking at the pre-market action, kind of mixed, maybe a little bit of downside bias. Dow futures currently down. Well, I say currently, this is a little bit of a delay. But I'm showing Dow futures down about 70 points, S&P flat, NASDAQ down about 20. So looks like we're going to probably get off to a little bit of a weaker start. But with so many earnings coming up, and then of course, we got the Fed policy statement out at 2 o'clock today. So there's going to be a lot of things for traders to consider as we move forward. But the undeniable thing is that we remain in this nice uptrend in the market. And so any kind of pullback or whatever, for the most part, is going or should just be seen as consolidation within a much bigger long-term uptrend. Let's go ahead and I'm going to take everybody over to Earnings Beats and we'll get this thing going. So if you are new to Earnings Beats, always love to have new folks join our community. You can do so by simply typing in your name, email address, hitting the subscribe button to our Earnings Beats Digest newsletter. This is a newsletter that I publish 3 times a week, Mondays, Wednesdays, and Fridays, normally out before the market opens, dealing with earnings, relative strength. I think this morning, actually, I talked a little bit about a short squeeze stock. We haven't talked much about short squeezes lately because really that was a big thing back in January, but the short percentages of float have come down quite a bit. Back in January, we had GameStop, with 140% of float shorted, just crazy numbers. And so everybody was jumping over everybody else trying to get out when we had that short squeeze push to the upside back in January. It's really calmed down since then. So there haven't been nearly as many opportunities on our short squeeze chart list. But when you do have a stock that's up near breaking out, near that resistance level, a key level, and volume's been picking up, and there's some, potential short squeeze activity that could take place, you want to at least be aware of it. And so the one stock that I wrote about this morning in there was Cellsci, which is CVM, which is a company that has already made a big move, but it's just at resistance trying to make a breakout. So that's one that we certainly could be keeping an eye on. But anyhow, those are the types of things that we talk about in the EB Digest. I think it's great information, very educational, and sometimes presents some good, solid trading opportunities. There's no credit card required, like I said, completely free, and you can unsubscribe at any time. But simply type in your name, email address, hit that subscribe, and you're good to go. All right, moving on to the action from yesterday. It seemed kind of weak to me, especially on the NASDAQ. You can see we were down 48 points. But, we got to keep all of this in perspective. The NASDAQ went right up to and tested the February high. I always look at opens and closes, not just closes. So on Monday, we had closed at an all-time high. That was the highest close the NASDAQ had ever had. but there was an open back in February that we hadn't gotten through. So I look at candle bodies, not the top, not the tails, the intraday, but I look at the bodies, which are essentially the open and the close. That's the top and the bottom of the rectangle in a candlestick chart. And so that's what I pay attention to as support and resistance. That's just my style. Feel free to do however you look at it. But just in my experience, it's like if a company gets, above on an intraday basis, but isn't able to clear on a closing basis, many times that's a top. You get those false breakouts. And so that's why I tend to pay attention to where a stock closes and opens, because when you think about it, market makers who determine opening and selling prices, that's where they have the most influence, is at the open and the close. And based on whether or not they have a long position or a short position, I think it matters where stocks close at the end of the day. Anyhow, so when you look at the action yesterday, it wasn't really much of anything, a little bit of back and forth, but the S&P up near 4,200, trying to get that first close above 4,200. The Dow hovering right around that 34,000 level. The NASDAQ struggling, but we hit that key resistance. Mid caps, by the way, another all-time high. Small caps starting to strengthen again above the recent highs. Not up to that March high, but we are in a nice uptrend. So I think things are looking pretty good on the indices, either in uptrends or confirmed uptrends, or simply consolidating, awaiting another breakout. Also, look at that AD line on all the major indices. Everything's up. So I just, I don't like to buy or sell strictly based off of AD lines, but I do like a stock or an index that I own or that I'm bullish on when they're in uptrends and the AD line confirms that. That just gives me a little bit more technical evidence that what I'm seeing on the price chart is real. If the price chart's going up and the AD line's going down, it's not that I would short the stock or that I feel like it can't go higher, but it is one check mark in the bearish column that you have to at least be aware of. Looking at the sectors, energy, industrials, financials were leading. And I think we're starting to see a resumption in the financials, industrials as well. We're going to talk about the 10-year Treasury yield in just a second, but we saw that bounce nicely off its 50-day yesterday. And today, things are looking up for the 10-year Treasury yield. And that usually bodes pretty well for these two groups, industrials and financials. Energy, as I wrote about in the daily market report, and I'll talk about in just a minute as well, I just see a bullish wedge here. So I think we're eventually going to break out. But if we do stay in this wedge to the downside for a little bit longer, we could go back down to about that 44 level. But I'll pull up a bigger chart. We can look at that just a bit. But those were the three that led. Utilities and healthcare, two defensive groups, were down on Tuesday. You can see utilities, though, testing that rising 20-day moving average. This would be an area where I would look for maybe at least some consolidation. If we can't hold the 20-day, then I think potentially we could go back down here just below $64 to test that breakout above the January high. And also you can see that 50-day moving average coming up. And then we've got healthcare, which had been on a pretty nice roll, just seeing a little bit of profit taking, not unusual there. PPO, very solid now on the XLV. So if we do see continuing weakness, I would expect that 120 level to provide us a little bit of support. All right, 10-year Treasury yield. I did mention earlier that the Fed policy statement due out at 2 o'clock today. I am not expecting anything significant, to be honest. I think that the Fed is going to continue to support the market. I would be shocked if they threw anything out there that would really spook the market. And when I say really spook the market, I think if the Fed, took an about face and said inflation's worse than we thought, that would spook the market. I don't think you're going to see that. I think they're going to stick to their guns, that inflation, that we are seeing a tick up in inflation, but that they believe it's transitory. I think you're going to hear that all over again. I believe you're going to hear that they're watching, the economy, but things are continuing to pick up, that they're seeing economic activity pick up, and that they expect the GDP. I think last month they said 6.5%. I think they'll stand by that. I wouldn't be surprised if they raise it at some point, but right now it might be a little early for that. But I think they'll stick by their forecast that things are still looking very good. And I believe they're going to continue to say they're going to keep rates low. And I think that's what the stock market wants to hear. And with all of that, my guess is we see the 10-year Treasury yield, because of the increased or the expected increase activity, economic activity going forward. I think you're going to see us probably in this new range now. I'm going to say 150 or so to the downside, 175, 176 to the upside. We're right in the middle of it now at 163, up a little over 1 basis point today. So this is the new normal for the 10-year Treasury yield. And I fully expect we're going to break out above 175, 176, I believe, in time over the course of the summer and into the end of the year. I think the 10-year Treasury yield probably goes over 2%, maybe even by the end of the year gets to 2.5%. But I think the only way it gets up there is if the economic engine is really running on all cylinders. And I believe it's going to. I think there's going to be so much demand later this year. I think growth is going to be continually raised, and I think interest rates will go up. But it's not just about interest rates going up. You've got to be cognizant of the level of increased economic activity. It's both of them that is going to drive valuations. So I think we'll see a little bit more of this back and forth between value and growth, with both leading it from time to time. But I do see the market continuing to go higher. At some point, I think it'll probably be, maybe we'll have to see how things evolve over the next few weeks. It could be in, the latter part of May and into June that we see a little bit more, but I really suspect it's going to be later in the summer. That'll be when we really have the bigger pullback. I could see the July to September period, potentially at some point dropping 10%. And it could be overall any kind of fears. It could be inflation fears. It could be interest rate fears. It could be, just pick one. Maybe something new comes out. Maybe there's another COVID variant. I don't know. That's worse than all the other ones. But there'll be something likely that'll pop up over the summer. But I think what's going to happen is the market's going to move up into that, and then we're going to pull back. And maybe when we pull back to where we are now. Maybe we go to 4,400, and then we pull back to 4,000, or we get to 4,500 and pull back to 4,100, something like that, before a late rally again later this year. I believe the fourth quarter will be strong, as it usually is. All right, moving on to a couple of stocks here for talking technically, or a couple ETFs, I should say. Let's start with energy, the XLE, because this was a chart that I highlighted in the daily market report. So if you didn't see that, or if you're not a member, what I would be paying attention to is here you've got a clear double top. That was a very, very significant high on the XLE back in June, and we tested it in January, and then we broke out. So I believe this 44.5 is kind of like the, if energy continued to weaken, I think that's the big level I would be watching. If we can't get back through a sustained move through the 20-day and we keep falling, that's something, closer we get to about 44.5, the better I would feel about trading energy. That doesn't mean I wouldn't trade it unless it dropped to 44.5. I'm just saying if it were to get down there, I would start to feel a lot better from a risk reward standpoint. But there's that bullish wedge I was talking about. So this is a pattern that off of an uptrend, I think sometimes these are misused, and, people just draw bullish wedges all over the place, whether they're after an uptrend or not. But these are continuation patterns. So you need to have an uptrend. And the start of the bullish wedge should be from the high. That's where you should be drawing your trend line on the top. And then the bottom, you can see it's almost like a piece of pie. Now you can have channels like that, which would be kind of a, equal slope on the highs and also on the lows. So if we were to drop back to say 44, I mean, we could be looking at something like that, which would just be a little channel. So if we do break to the downside out of a bullish wedge, I wouldn't necessarily say that, hey, that's a really bearish development. And what I'm talking about here is, let me see if I can get this turned a little. So if we go back to that, and let's say we break below 46, and then you're like, oh, well, the bullish wedge broke down. I would still be looking at the 44.5 level as the major support level. And what I would be doing is maybe simply moving that to look more like a channel. So I think the XLE is in a really good place. I don't, I've said before, I don't think it's going to be the leader in 2021 over the balance. I still think the dollar is going to go up. It hasn't been proving me right lately. We had a nice pop in the dollar, and now for the last few weeks, we've been seeing a pretty steady downtrend, and that's helping energy and materials to some degree right now. I don't know that that'll be the case later this year. But anyway, energy, I think, remains in an uptrend, short-term downtrend. So if we break back up above the moving averages and break out of what I think is this wedge right here, break out of that to the upside, that would be a bullish development. So just kind of keep that in mind as you're looking at the XLE. All right, next up, let's look at the XLF. Because we got financials, which tend to do well when yields are rising, and yields are rising. Now, we do still have, as you move up here, slight negative divergence. And you might look at this and say, well, that's not slight. Prices are higher and the PPO is lower. What I mean by slight in this case is that the XLF PPO is only at 1. It's not like we have a lot of upside momentum. And the reason is that we had this nice move up. We're up to 3 on the PPO, but even though we're going higher, it's kind of like been a little bit more tortured move to the upside. It's been a little tougher to make that move. And as a result, some of that positive momentum has slowed. And so now that PPO, which was 3, is now down to 1. So I could see selling, let's say the 10-year Treasury yield moves down one more time, back to maybe 1.5%. I wouldn't be surprised to see financials move down to 34, test that 50-day, which we haven't tested since the end of January. Maybe get that PPO back down to the 0 line, which we haven't seen since the beginning of February. That wouldn't be a bad thing. What I would be looking, when I'm looking at the market, what I would be thinking is we're in a secular bull market. And so when something sells off, I'm looking at it as an opportunity. Some might be looking at it as a breakdown or a potential breakdown, or, oh no, financials are losing strength. If this goes down the 50-day moving average, I think the reward to risk just got a lot better. That's the way I would look at it, because I am looking at the market from a secular bull market perspective. So I don't want to hear about all the negativity. The charts aren't telling me that things are going to be bad. The charts are still telling me we're going higher. And so as long as I'm feeling that in the charts, I don't care what news story breaks. To me, it's an opportunity. And so if, like I said, something breaks and the yield goes down for whatever reason, maybe the Fed says something really dovish today and we get that yield dropping and the financials get hit. Remember 34, that level on the XLF would be very strong. Or just the rising 50-day. It doesn't have to be 34 because this will continue to go up. And then we got the XLI. XLF and XLI tend to do pretty well when rates are going up, because normally what that's telling us is that the economy is strengthening. That's why folks get out of bonds, and that's why the yield rises from the selling of bonds. That's always the case. When yields are going up, people are selling bonds. That's why yields go up. And the reason you sell bonds is because the economic activity is picking up and you want to be in stocks. So, and again, that's why the yield, when the yield rises, stocks tend to go up. And so when you hear these stories, oh, interest rates are up, this is bad for stocks, ignore it. Ignore it. I can't be any more forceful than to say ignore it. If rates are going up because of inflation, that is a different story. We've got to keep an eye on inflation. If the Fed starts talking up inflation, then we could be in for that correction I'm talking about. So pay attention to what the Fed says about inflation. If the Fed comes out today and says, inflation, yes, we recognize it's up, but it's transitory. We don't think inflation's a problem. We're fine with inflation going above and staying above our target level for a period of time. Take the Fed at their word. Now, you might disagree with that statement because I don't always take the Fed at its word, but based on everything I'm seeing on the charts, I don't think inflation's a problem. So we'll see, what short term, we're going to get those headline numbers on inflation. That's going to scare folks, but that's going to happen. I mean, if you look at the way that they do the year over year, the next couple months are going to replace last year's, the April, May, June, where we had the big drop in inflation numbers, the CPI and the PPI went negative. Those are going to be removed. And now all of a sudden we're going to have inflation numbers that are positive for these months. So the year over year is going to go above the Fed target level. It is absolutely going to go above, and it's going to remain there for a few months. And that's what the Fed is talking about. Just keep all of that in mind. All right, so there's the XLI. Very similar to the financials. I think, we're starting to see some of the momentum slow a little bit. PPO is only at 1.44 right now. Again, could we go back down and test the 50? Yeah, I think, if the Fed does something or says something that keeps rates low or makes them go down, then I think we'll see more rotation out of financials and industrials. If the Fed just simply talks about economic activity and how they're expecting things to strengthen, but inflation's not a problem. If yields continue to rise, that scenario, I think, favors financials and industrials. So we'll see how things go later today, but I wouldn't be surprised to see all sectors moving higher. Secular bull market, wide participation is a hallmark. Rising tide lifts all boats. That's my mentality when I look at the charts. I don't look at the charts and say, I'm really bullish this group and I'm really bearish this group. I'm just either really bullish one group and more cautiously bullish another group. That's kind of the scale that I'm on right now. All right, we've had so many earnings out. I want to spend some time going through all the earnings, well, a lot of the earnings that came out overnight and this morning. So let's go through some of these. Visa, and let me see how many I have on my list here. I'm not going to have time to go through all of these, but I probably have about 50 to 55 companies on this list that I'm looking at. 5 companies missed earnings. Think about that for a second. 55 companies that I have on this list. And I think one met estimates. Yeah, I've got one that met estimates exactly, which was EQR. The 5 that missed that I'm showing, and there were probably more, but these are some of the bigger ones that I just had jotted down. Amgen was one of the bigger companies that missed. $3.70 versus $4. And here's the reaction to Visa, by the way. Visa was the biggest name in terms of market cap last night. So the Visa's up nicely, and they beat $1.38 versus $1.26. But let's take a look at Amgen. Amgen, $3.70 was earnings per share. Market was expecting $4. So they missed by 7.5%. And stock down almost 4%. But it's in pretty good shape. I mean, I think probably I would watch this 245 level. If it fails to hold, I think you've got gap support down here in the upper 230s, maybe that 50-day moving average. But biotechs have not been one of the stronger areas in the market. So Amgen isn't one that I would have been looking for. The next one I'm going to show you is one that I'm shocked by. I had mentioned it in the earnings webinar the other day, Stryker. I thought this was a really nice looking chart. Big move up into earnings. I'm thinking, okay, they're going to come up with a big number. They missed $1.93 versus $1.98. Now they are in healthcare, so maybe a little caveat there. The healthcare stocks haven't been performing overall the way some of the other areas have. But Stryker, when you look at it here, it was going straight up. Normally, that's a sign that Wall Street's visited the company. They like what they're hearing, and they come back, because they can't, there's a quiet period at the end of the quarter. They can't talk to companies after the quarter ends until the earnings report comes out. So for this whole period, Wall Street's not talking to anybody in management, or at least they shouldn't be. And so as a result, all this buying, you suspect, was based on information that they got at the end of March. And so I'm braced for a great report. They're expecting $1.98. I'm probably waiting for $2.25. And yet we got $1.93 and the stock down almost 2%. Now, I don't like it when companies miss. So that I wouldn't short the company, but this is a company I would strike off my list. No pun intended, Stryker. But I would not be, this won't be on our strong earnings chart list, obviously, because they missed their earnings estimate. So this is just something that, in the back of my head, I keep in mind. When companies miss, they essentially have promised Wall Street something and they didn't deliver. And I don't like that. Wall Street generally doesn't like it. So this is a company that I'd be very careful, especially if I own this and I kind of held for the day or something to see what would happen, and it went back up later today and went to maybe breaking out on an intraday basis and then sold off again this afternoon, that would be it for me. False breakout on the stock after that kind of news, I would be out. And if I were to short a company, it would be something like that, where it's got a false breakout. And if it breaks back up above that false breakout, I just put my stop in. So I can really minimize the potential for a loss on the stock. All right, what else do we have here? Let's take a look at, see some of these others. UDR missed 47 cents versus 48. Market doesn't even seem to care. USNA, this was another one that kind of surprised me. Well, we hadn't broken out, but I kind of thought this might be the catalyst for a breakout. We needed to get through that 102.50 area, but they missed $1.45 versus $1.57. And then the last one they missed is not a surprise to me at all, and that's Boeing. Boeing, just on their chart, didn't look overly impressive. They missed. They came in at $1.53 loss, and the market was expecting a loss of $1.17. So Boeing not trading very strongly here, but holding that 230 level. I think maybe we go back down, visit that. But I think there's more about looking forward on Boeing. I think everyone, well, I say everyone. When I look at the chart, I don't expect a whole lot out of Boeing. So I'm assuming Wall Street wasn't expecting a whole lot out of Boeing. So they did miss, but things are going to pick up later this year. I don't know that these companies necessarily are going to get hit that hard. Remember the big theme, secular bull market. So even stocks that are weak probably are going to grow their earnings later this year. And so they might be weak for a period, then start looking to see if they begin to build relative strength again, heading for their next quarterly report. All right, so those were the ones that missed. I'm going to give you some of these that just, and not all of these were positive reactions, by the way. But let me pull up first Texas Instruments from last night. $1.87 they reported. They were only expected to report $1.56. They beat by 31 cents, 20% beat over expected earnings. Stock down 3%, down $6. But look at Texas Instruments. This is what I was referring to earlier. You get these moves up, and then you get great earnings, and you don't break out, and you're frustrated. But you also have to understand that these companies have made pretty big moves, and they're consolidating. And part of that consolidation, even with strong numbers sometimes, is a negative reaction to earnings. Probably a really good example of this is even Starbucks, which raised their guidance. They came out 62 cents versus 52 cents, raised their guidance, stock down 2%. But on a pullback, I'd be building a position in Starbucks. I really like Starbucks. I like consumer discretionary this year. Starbucks, one of my favorites. It's one of the top restaurant stocks right now. And so I think any kind of a pullback is an opportunity. Maybe you just, if you're interested in Starbucks, maybe you think about building a position as opposed to just jumping into whatever you want. Because there's nothing that says that Starbucks can't go back down, to 112.5, 110, even 105, back to these lows. It's not out of the question. You'd still have an uptrend in play. So I'd be using weakness to accumulate positions in something like Starbucks. AMD. Now, AMD had been weak. They came out and beat, and they're getting a nice reaction, 4.25. And the stock now has trended back up above some key resistance, above its 20, which is now above its 50. AMD is starting to show more bullish action. But I would be tending to use any weakness to build a position in something like AMD. Another one, this one, I'm not surprised because the stock went up so much. But Pinterest, after that huge rally, we've been consolidating now. 90 to the top side, probably 62.5 to the downside. Stock's down 11% after posting numbers. They reported their earnings at 11 cents. Market was expecting 7 cents. That's more than a 50% beat. Stock down 11%. But it's within the confines of this sideways consolidation. So, maybe we get another push back down to 62.5 on Pinterest. I would view that as an opportunity. Enphase. Enphase had just started to get stronger. And you can see the stock now down $20, down 11% as well. and they came out with their earnings, expected 41 cents. They posted 56 cents, beat by 15 cents. Market doesn't care, down 20 bucks, back to 150. So back down below both of its moving averages at the open. Assuming that's where it opens, we're pretty close. Actually, we're just opening now. Give you a couple more here and then we'll wrap this up. Looking for a stock that had a really big beat. Boyd Gaming. This was one I actually talked about. I'm just going to pull up a regular chart on it since it should be open now. But, well, it hasn't opened. Yep, still no action yet on Boyd. Should be opening here any second. Boyd reported 93 cents versus expected 44. And it's when I see companies like this, and then I read arguments that the PE ratios are too high in the market, and I go into rants on this all the time, but it really is frustrating to me because I think it's so misleading to post that we're at all-time highs on the PE ratio, therefore the market's, way overpriced. After this earnings season, when we get through all of these numbers, that earnings part of that ratio, the E part of the PE, is going to be so much higher. And if price doesn't go anywhere, the PE ratios come down. They'll be coming down by a lot. But I don't think the price is going to come down. I think price continues to go up. But I think the earnings are going to go up faster than the price. And so I think PE ratios will come down and be much more palatable over time. The other thing about PE ratios is you have to understand the big picture on interest rates. And you have to understand your alternatives to investing. I'm going to pay a lot more for earnings growth in an environment where I'm getting 1.6% in a 10-year Treasury yield. If the 10-year Treasury yield right now was at 5 or 6%, then yes, the stock market would be very overvalued. I would agree, 110%. Not just on the charts, but based on my background as a CPA and valuing companies, that would be very significant. But it's not. The 10-year Treasury yield's not at 5%. You don't have the option to have risk-free income of 5%. You have option of risk-free income of 1.6% using the 10-year Treasury as the risk-free. Now, that's not exactly risk-free, but chances are you're going to get your money back. Interest rate, there's still an interest rate factor in there. But anyway, I think that whole PE argument is so ridiculously wrong in this environment. And some will say, yeah, that's what they were saying in year 2000. This is nothing like year 2000. Absolutely zero like 2000. 2000, we had all the dot-com companies, had no earnings. They were just splitting their stock. They had nothing to trade off of. Companies were raising money left and right, naming, spending $200 million to name a football stadium, having lavish parties. They weren't making any money. These companies are making money hand over fist. So anyway, so Boyd Gaming, I think, is one that looks pretty interesting. Another one that I talked about, let me see if we got an update now on BYD, see what it's doing. So it gapped up. Now it's pulling back. I mean, who knows where this thing goes intraday? I don't care how good the earnings are, how bad the earnings are. Trying to figure out what the stock market's reaction is going to be after earnings is literally flipping a coin. I mean, you're just gambling. We gapped up, which I think is bullish. I don't know if we're going to fill the gap and turn and go back higher, or if we're going to sell off to the 20. Maybe we're going to go all the way down today to 61, even though the numbers were great. I mean, again, look at Pinterest. Those numbers were really nice. Look where we are. We're down $10, 67. Starbucks. See what Starbucks is doing. Down 368, down 3% after great numbers. So we just don't know. But here's another one, NAVI. And we'll go ahead and start the three you must see here. Let's do 3 earnings. So NAVI, listen to this earnings report. Expectation, 78 cents. They came in $1.71. I mean, it's not even close. That you wonder, okay, how can a company go from $8 or $9 up to 15 in 3 or 4 months? Well, this is how. This is the market telling us, beating us over the head that they're going to come out with good numbers. And they did. Now, sometimes it's a buy on rumor, sell on news. So if later today you see a big red candle and NAVA trading at 14, don't be shocked. I'm not saying that's what's going to happen. I just won't be surprised if that's what happens. The bigger picture is that this company's growing earnings rapidly and it's in an uptrend. That's the more important thing that I'm getting from this. All right, last two stocks for the three you must see. Let's take a look. How about Shopify had a great report. Talk about an earnings beat. Stock's up $41, so it's up 3%. Hasn't broken out. So technically, I wouldn't say that it's a buy. I think long-term it's a buy. Short-term, I'd like to see it get through that 1250 area, and we didn't even open above that. But listen to this earnings. Expected 78 cents, $2.01. And so folks say, well, I don't understand how Shopify, it's one, so overvalued, can't possibly go higher. And then you see earnings. And what you have to understand, the way companies are valued is, was this just a one-time thing where Shopify now is posting $2.01 earnings? Or all those firms that had the consensus estimate pegged at 78 cents, do they now need to go and revise all their future earnings? I think they probably do. So what's likely to come down the road are earnings revisions higher on companies like Shop. And as that happens, you're probably going to see the stock start trending back to the upside again. Last one. Let's see, what's another good one? Well, Santander, SC, this is one I had mentioned that looked really good. I think it's in consumer finance. Before I pull up the stock, they were expected to earn $1.45. They reported $2.42. Now, I know the chart looked good when we looked at it at the earnings preview, and it's continuing to go higher so far. Now, we don't know what the rest of the day is going to hold. Only 36,000 shares have traded so far. Again, don't be shocked if we have a big reversal to the downside, kind of like I was talking about with Navient, NAVI. Hard to say where it's going to go. But what I like to do with earnings is see the report, see what happens, not just to the stock, but how they perform, how these stocks perform on a relative strength basis versus their peers and versus the S&P 500, even over the next couple of weeks. And let's get a sense of that. And that's going to, then you want to start looking at those companies, the really good, solid relative strength companies, great earnings reports that have pulled back. Because I think market makers are building positions for institutions. That's the first thing that I think of when I see great reports, great fundamentals, and a really nice looking chart that all of a sudden sees weakness. I just think folks getting in at the top after the earnings, after the news comes out, they're going to panic sell when they see these big red candles. And there's a stock yesterday, one of our portfolio stocks, AMKR, got hit hard yesterday after earnings. But I see this whole area right down in here is really good support, 19 to 21. And we went right down to 21. But anybody that got in after the earnings came out, the earnings were pretty good on AMKR. Stock gapped down just a little bit, but then sold off all day long. And so anybody getting in at 24, not going to be very happy at 21. And so that's the kind of emotional toll that trading takes on somebody. I mean, AMKR was priced for perfection back early April. Stock was 27, 28 bucks. Now all of a sudden they've come out with great numbers and they're at 21. And anybody buying at 27 doesn't want to hear about what a great stock it is. You're down $6, you're down 20 some percent. Not going to feel very good about that. All right, that's it. Let's get a quick update on the market, see where we are, and we'll wrap this thing up. S&P, kind of like we were at the beginning, Dow's down, NASDAQ's down, S&P's flat, basically. Small caps and mid caps down just barely. They're relatively flat as well. We'll see if they keep up their relative strength. S&P 500, let's get a couple of quick updates here on the leaders. Not really seeing anything there. I know MDLZ reported, looking at that chart, that looks like a really nice breakout. And then down there's your end phase down 11%, Starbucks 3%. Many of these companies on the list there's Amgen, F5. These were all companies that have reported. So anyhow, that's it. Went a little bit over. Sorry about that. We'll be back tomorrow for Trading Places Live, the recorded version over at Stock Charts TV. That'll air at 9 a.m. Eastern on Thursday. Hope everybody can join me, and have a great day, everyone. Happy trading.